A very good evening, everyone who are here with us on Zoom webinar, as well as our audience for Facebook Live. Thank you for joining us at the Corporate Connect webinar, which is organized by SIAS and supported by SGX. Also, I'd like to thank UOB Group for joining us this tonight, who will be doing a corporate presentation for us later. My name is Zach, and I'll be your MC for this evening. Tonight's webinar will kick off with a market highlight session by Mr. Jeff Howie, market strategist from SGX, followed by a presentation by Ms. Priscilla, Vice President, Investor Relations for Group Finance and Corporate Services, UOB Group. We will end off with a Q&A session moderated by SIAS. Well, I'm sure everyone here knows UOB Group very, very well, and probably more than half of you here have an account or credit card with them. But just a little background for you to know, UOB has a global network of more than 500 branches and offices in 19 countries and territories in Asia Pacific, Europe, and North America. UOB provides a wide range of financial services globally through their three core business segments for group retail, group wholesale banking, and global markets. They are also rated among the world's top banks, AA1 by Moody's and AA- by both S&P Global Ratings and Fitch Ratings. Now, don't be mistaken, everyone. Today, they are not here to ask you to sign up any accounts or credit cards. But, however, after hearing Priscilla out this evening, you may change your mind. After learning about their business plans and performance, you might just invest in their shares, also sign up their services as well. So which I'm sure they'll be very happy to know that. Now, before we get into that, let us first start off with the market highlight session, which I would like to invite Mr. Jeff Howie, market strategist from SGX, to take over the session. Over to you, Jeff.
Thanks very much, Zach. Let me just share my screen and let's move right into it. So good evening. As always, this is all educational material on SGX's front. And where we are today is the STI currently at 3130. That brings the year-to-date decline in total return to 3.4%. And that followed, so that's a decline of 3.4%, and that followed an 8.4% total return last year. What we were looking at, in fact, I think just last week, was the March MAS survey of professional forecasters, finding that the most likely growth rate for the Singapore economy would be around 2% this year, and most cited downside risks to the domestic growth outlook were, I guess, the escalation in geopolitical tensions, inflationary pressures, spillovers from external growth slowdown, and they were ranked the most topside downside risks. On the other side of the coin, the most frequently cited upside risks to Singapore's growth outlook was for more robust growth in China. And that, of course, comes from its economic reopening and macroeconomic policy easing. You've also got upside risk from a better than expected external growth and a faster tech cycle recovery. Now, those downside risks, as we said before, were those inflationary pressures, geopolitical tensions, and of course, spillovers on external growth from higher interest rates. The other fourth risk, which did come to fruition last year, is financial stability, and that was with that Prime Minister Liz Truss for a little while, who made that those fiscal initiatives that really saw some volatility in the sterling and the UK stock market, and that also had reverberations to adjacent assets and markets. And we've seen a little bit the same with SVB and the Signature Bank and so forth, the banks that are focused on technology, venture and high net worth type of customers, give a little bit of a rock to financial stability. So that's always been the fourth risk, but we've been doing so well with it that it's not frequently touted. But obviously, I mean, this is just what's been happening recently since Thursday. Friday's been getting so many headlines that I guess now it will continue to be a financial risk going forward, I guess, a potential downside risk to markets, because generally last year we had less and less volatility. If you look at global stock markets and bond markets, we started off more volatile at the beginning of last year, and that generally tapered off. So what is happening as well is because of this, we're seeing policy adjustments in the US, and recent developments in the US bank sector obviously have had an impact on the outlook for the Fed funds rate at the next FOMC, which is on the 22nd of March next week. A week ago, the majority of expectations were for a 50 basis point hike, but now it's back to a 25% thereabout expectations for a pivot to no change, and now majority expectations, 73% expectations for a 25 basis point hike. So given the little bit of the increase in the volatility in the US stock market just over the last 2-3 sessions, you've seen the expectations for a less hawkish Fed. Now, a lot still pivots on inflation, and tonight's going to be really important as well. In fact, at 8:30 p.m. tonight, so got to make sure Priscilla's finished before 8:30. I'm sure we'll be finished by 8, but should just mention the Fed CPI will be released tonight in the US, and the expectations are for it to be at 6% year-on-year growth. It follows a 6.4% print in January. So obviously anything better than 6% will be very much welcomed by the market. I should, go back to this sector slide here. I guess looking at some of the sector switching we've seen in terms of flows this year, as I said before, the STI is down 3% so far this year when you take into account the dividends and the price performance. And utility stocks, interestingly, for the first 10 weeks of the year, had been among the weakest performing sector across the global stock market. But in Singapore, the utility sector has been booking net institutional inflows, and that's pretty predominantly on the back of Sembcorp Industries pressing ahead with its transition towards a greener portfolio to create, obviously, this type of new long-term value for its shareholders. Consumer cyclical has been the best performing sector in the global stock market so far this quarter. And that has paralleled here in Singapore because that's also led, consumer cyclical sector has also led the net institutional inflows into the Singapore stock market so far this year. The stocks that have led the flows, predominantly Genting Singapore, Best World, and Halcyon Agri. Banks have actually seen net institutional outflows so far this year. And led the outflows, and that's been happening gradually through the year. I think it was about 200 million of outflows in the first month of January. That followed 100 odd million of net inflows, net institutional inflows last year, and I think the trio combined drew 1.7 billion of net combined institutional inflows back in 2021. So flows also got to point out that they are proportionate to the size and the turnover of the banks. And in Singapore, our 3 banks make up something like 20% of our total market capitalization, and also more than 25% of the day-to-day turnover. So they will generally have more outflow and inflow than a sector that, let's say, makes up just 5% of market cap and 5% of turnover. I should also mention, after booking outflows last year, tech has booked inflows this year, net inflows led by Venture, Nanofilm, ISDN Holdings, Franken, and UMS. Venture's booked about 15 million Sing of net institutional inflows so far this year, and that follows the broader market with, I guess, share price declines over the past month or so. But the group did report 18% net profit growth last year, remember. And according to Bloomberg, they also ranked the stock as the 12th most defensive technology performer among the 200 APAC tech stocks that have a market value of more than $3 billion last year. Let me move straight into the banks, because that's what we're here for predominantly. The trio have DBS, OCBC, and UOB. They've averaged 29% total returns since the end of 2019, and that brings their average 10-year annualized total returns to 8%. And they maintain a 45% weight thereabouts within the Straits Times Index. The trio, they also maintain a combined close to 4% weightage in the FTSE Developed Asia Pacific ex-Japan Index. Now, what's interesting is that weightage actually increases by more than 2.5 times to the subset index of the FTSE Developed Asia Pacific ex-Japan Sustainable Yield Index. So they maintain, the three of them maintain a 10% weightage in that index. And that FTSE Global Sustainable Yield Index, it actually excludes extreme yielding stocks, and it examines the financial and operating strength of prospective constituents. So it's looking at things like profitability, capital structure, and operational efficiency. And it has specific emphasis on companies with strong balance sheets and the ability to generate cash flow. So those three banks actually rank as top 10 constituents of that index, the FTSE Developed APAC ex-Japan Sustainable Yield Index. And the banks also maintain high liquidity coverage ratios and net stable funding ratios and so forth. For their FY22s, which all ended in December, the trio also all reported record net profit. So DBS reported its 2022 net profit grew 20% to 8.2 billion from the year before. Its total income was up 16%, and that crossed a $16 billion threshold for the first time. UOB, when it reported back on 23rd of Feb, it had a record high core net profit of what is, I think, 4.8 billion in FY22. That was up 18% from FY21, and including one-off expenses relating to the acquisition of Citigroup Malaysia and Thailand's consumer businesses, which did also come online last year. UOB's net profit was also at a record high of 4.6 billion Sing dollars. So OCBC, it reported the morning after on the 24th of Feb, and its net profit increased 18% to 5.7 billion Sing dollars. So when you put it all together and you put the three together, the combined total income of the trio, it increased to near 40 billion Sing dollars last year, with the combined net interest income up 30% to 27 billion Sing dollars, while the non-interest income component declined 9% to near 13 billion dollars on lesser fees and wealth management, with the fall in most global stock markets last year. So DBS, it reported its full year commercial book total income was up 21% to 15 billion Sing, and its net interest income for its commercial book rose 40% to 10.7 billion Sing. And this was attributed, of course, to the rise in net interest margin. So for its commercial book net interest margin, the NIM was up by 48 basis points to 2.11% last year. And it also, importantly, for our three banks as well, not just expanding NIMs, but the ability to grow their loan books. And I think DBS saw its loan growth up 4% last year. And this, of course, partially offset that lower wealth management and investing banking fee income. So I thought what I wanted to relay was DBS's CEO. He did maintain that guidance was for mid-single digit loan growth for this year and double-digit fee income growth. And it also, DBS also put out its annual report last week, and it stated that its loan portfolio, and I think this is an important point, particularly over the last few days, it's well diversified across industry and business segments, with building and construction, I think general commerce, manufacturing remaining the largest contributors in the wholesale portfolio, which accounts for around 48% of the total portfolio. OCBC, as we said, it reported net interest income growth as well, up at 31% year on year. And that was underpinned, of course, by expanded in net interest margins. They saw 37 basis point expansion and 6% growth in average assets. With its non-interest income down, I think it was down 16% from the previous year. So net fee income for the year was 1.85, and that was 18% lower than FY21, attributed to softer wealth management fees to the prevailing risk-off investment sentiments, which we saw at SGX as well, in terms of trading turnover and so forth. I won't go and talk any more about the UOB statistics, because obviously Priscilla can do a much amazingly better job than me. But what I will do is just look at this recent report that was strategy consultant EY Parthenon, who basically, I think a few weeks ago, put this paper out, and they said there were 3 key themes for investment banks across Asia Pacific in this year, and they include, number 1, the pursuit of customized and experience-led operating models that enhance client and colleague experiences. Secondly, technology adoption, and thirdly, gaining headway in sustainability. So I guess just before we introduce Priscilla, I'll just share with you that I think exemplifying all 3 of the themes, we have UOB, the TMRW Tomorrow app was designed to create simple, engaging, transparent, hyper-personalized digital banking experiences. And that platform does enable the bank to acquire and I guess also serve the very huge base of digital first customers that are really emerging across Southeast Asia. And it does complement its omni-channel, very much like we've been seeing with the big regional retailers, and offers the customers options of physical touch points to serve their, I guess, their more advisory and the more complex financial requirements. Technology adoption has also helped to embed UOB's products within this expanding ecosystem of these strategic partners like BAAS ecosystems. And the bank has also broadened its digital payments and trade capabilities for its corporate clients. And this book is really good. This is a book by Dennis Koo, and it provides a very, very detailed analysis on UOB's journey to digitalization. I'm close to halfway through. You can buy it in the Singapore bookshops, but if you can't find it, drop me an email and you can read this after I'm finished. I'm more than happy to send it to you. So that's on the tech part, but also on sustainability is really important. And the bank has continued to make headway on its sustainability strategy. I think it announced its net zero commitments by 2050 last year. That's UOB, and they committed to exit financing for the thermal coal sector by 2039 and cease new project financing for upstream oil and gas approved for development after last year. The bank's also partnered with leading global consultancies, obviously, to develop its improved climate risk assessment methodology, and this details of this methodology and the assessment results will be disclosed in their sustainability report, which will be released this year pretty soon. So I think I'm going to finish right now. I think it'd be a great time to hand over to Priscilla, and I look forward to seeing you again in a couple of weeks. Thank you so much.
A big thank you to you, Jeff, for the insightful sharing on the market trends and highlights. Up next, I'd like to invite Ms. Priscilla Chitra, Vice President, Investor Relations, Group Finance and Corporate Services, to do a short presentation on the company's latest business and financial updates. Priscilla, over to you. Thank you.
Thank you, Zach. Hi, good evening, everyone. Glad to have you all joining tonight. So I'll just move to discuss some of the presentation, and then I'll take questions during the Q&A session afterwards. So just to take you through the agenda for tonight, if we put on, this slide. Okay, so on the agenda tonight, I will first run through an overview of our bank, our UOB Group, and we will talk about the bank's growth drivers. I will also show you our consistent long-term track record of execution in delivering our goals. And finally, I will provide you with a summary of why you should invest in UOB. Moving on to the next slide, so I'll just on the overview here is a snapshot of our group, its history, and some of the financial highlights. So UOB was founded in 1935. For almost 90 years, the founder's family has always been involved in the management of the bank. And our CEO, Mr. Wee Chong, is the third generation of the family running the bank. His family remains the largest shareholder with 18% stake in UOB. So over the years, we have established significant presence in the region. we have the most diverse ASEAN franchise compared to other Singapore banks. We have an asset size of 320 billion Singapore dollars at the end of 2022. And last year, we generated close to 12% return on equity. Our capital position is solid, and UOB is also one of the highest rated banks in the world. Zach mentioned about this. There's not many banks in the world that have this level of rating from the 3 major credit rating agencies. Next slide, it shows the main division of the bank. So I think most of you would recognize us as a sizable player in mortgages, credit cards, and deposit accounts. We are also leading SME bank in Singapore. But besides this retail and SME banking, we also have been growing our institutional and corporate businesses. In Singapore, our home market, we control about 21% market share in Singapore dollar loans and 24% of Singapore dollar deposits. Next slide on this chart here is a track record of execution over the years. So throughout the years, we have demonstrated a consistent track record of execution. We have remained profitable year after year, as you can see in the chart, even during various global crises and economic downturns. So compared from 1980 to now, our profit has grown by over 50 times, thanks to our organic and inorganic growth over the years. So if you look at this chart, there were basically 2 periods of acquisition in the past. The first phase around 1970 and 1980s, and the second phase happened after the 98 Asian financial crisis. After that, we took a long pause in terms of doing acquisition because our management is conservative and prudent with regards to growing inorganically. So I think for us, the key is always to find the right strategic fit to be executed at the right time at the right price. So now after 17 years, we finally went ahead with another acquisition. So Geoff mentioned earlier about our Citi acquisition. This time we are taking over 4 markets in one go. So we made a deal to acquire Citigroup consumer banking businesses in Malaysia, Thailand, Vietnam, and Indonesia. So we announced in November that we completed Malaysia and Thailand acquisition and consolidation last year. And we just did Vietnam consolidation 2 weeks ago, and we expect Indonesia to be coming on stream at the end of the year. So in a nutshell, if you believe in the growth potential of the region in ASEAN, you can continue that. You can continue to expect the upward trend in UOB's earnings to continue in the long term as we further grow our franchise. Next slide on this slide 7 is a snapshot of our footprints in the region. So we are present across Asia, especially with a focus on Southeast Asia and Greater China. And with the Citi acquisition, we believe that our franchise in the 4 Southeast Asia markets will deepen further. In terms of our broad business strategies, we focus on retail and wholesale banking businesses. So on the right-hand side there, you can see that retail is almost contributing 30% of our operating profit, while wholesale contributes about 2/3. In retail, we see large potential in ASEAN with over 650 million of populations in this part of the world and a young demographic. I think Singapore as a wealth management hub, as you know, we benefit from the rising wealth in the region, and we want to capture that opportunities as a bank. Our assets under management grew steadily over the years. So now we have reached 154 billion at the end of 2022, which is a significant figure. And in the wholesale side, just basically touching a bit on this. So we focus on facilitating trade flow opportunities when our corporate clients transact across the region. So we see there is a growing cross-border needs of these multinational corporate clients across Greater China and Southeast Asia, as well as within Southeast Asia. And we want to facilitate these trade flow opportunities. I will talk more about the strategy in the next section. So if we move on to our growth drivers and especially our strategic priorities. So further expanding on our retail strategy, we have an omni-channel approach to engage customers. So here, what does omni-channel means? It means that we use both digital and traditional channels to serve customers. As I mentioned earlier, we see opportunities to provide wealth management solutions to our customers. And we want to be by customer side throughout their different stage of life. So we want to be easily accessible, easily reachable by them. So we are available through a mobile internet banking channel, as well as keeping the access for face-to-face interaction, because some of the transactions, especially larger size ticket transaction, people will be still comfortable to meet in the branch. And on the wholesale side, we aim to be for the trade bank in ASEAN. As I mentioned also about the connectivity across the region. For instance, we see a longer term trend from our corporate clients that want to diversify their production base out of China because of the growing US and China geopolitical tensions. So we think that countries such as Vietnam and Indonesia, I mean, in ASEAN can benefit, and we can provide solutions for these clients in their supply chain relocation journey. So this is just providing you an example of what we do in the wholesale banking side. And then sustainability is also another key pillar of our business. As mentioned by Geoff, so in October last year, we announced our net zero commitment by 2050. We aim to help customers transition towards greener paths by providing them with sustainable financing solutions. So we see this as a huge opportunity. At the same time, we want to ensure that we are facilitating the transition in an orderly manner. So we want to balance between climate goals as well as social and economic consequences. On the next couple of slides, I just want to highlight you some updates with regards to our Citi acquisition. So we see this acquisition as a well-timed investment that greatly complements our ASEAN strategy. And in the first 3 months, at least from November, we consolidated Malaysia and Thailand. We have seen encouraging signs. So our margins and fee income have been boosted. The operating costs have been reasonable, and asset quality remain well managed. We expect in overall Citi acquisition in the 4 markets to give additional uplift of about $1 billion in income to UOB and to strengthen our retail value proposition in the region. Now with the large customer base, better product offering and cross-sell opportunities, as well as the ongoing reopening of the regional economies post-COVID, we think we can even exceed our original targets for 2026. And then the next slide is also some more further observation from Citi acquisition. So I just want to call out some figures which are important. So from Citi, Thailand, and Malaysia, we added 1.3 million customers to our retail base. More than 80% of these customers are digitally savvy. They are also active card spenders with average billings or spending 2 times higher than the industry. We also brought about a strong wealth franchise that contributed 20% more to our assets under management in Malaysia and Thailand. So overall, with the enlarged consumer banking franchise, the ASEAN 4 income contribution to the group has increased from 25% to about 30%, which is good for our income and earnings diversification. And next is overall on the consumer story. So with the addition of Citi of 1.3 million customers, as I mentioned, and our organic customers acquisition also throughout last year, we now have close to 7 million retail customers at the end of 2022. We also grow our strategic regional partnership further. So we aim to continue to drive customer engagement, and this eventually will boost our income. On credit card fees, I'll just highlight you this figure because it was growing robustly, 25% year on year last year, partly growing, boosted by the contribution from Citi, as well as the pickup in travel spending, shopping related activities by our customers in the region. So as I mentioned earlier, we have an omni-channel approach to engage customers. Our omni-channel customers on average generate 3 times higher revenue compared to traditional revenue customers. So we continue to see good results from our strategy. And next, I'll just talk you through about the wholesale banking side of our business. So this division continued to show a good performance last year. And looking ahead, we see growing cross-border opportunities as economies reopen and companies diversify their supply chain. So again, we stand ready to capture these flows with our cross-border income growing 12% year on year last year, and now contributing about 1/3 of our global wholesale banking income. And similarly with the retail side, our wholesale banking division also leverage on digital platform. So this is to improve convenience and also security for our corporate customers. So as you can see, digital banking transactions and cashless payments to businesses have increased significantly last year. And next, on the following slide here is again highlighting our sustainability front. So we have achieved internally, we are carbon neutral since 2021, and we continue to be committed to achieve net zero target externally. So by working closely with customers to assist them with their transition journey. And as I highlighted earlier, our net zero ambitions must go hand in hand with an orderly and just transition. So even as we cut our carbon footprint, we must ensure that our customers, the people's livelihoods can continue to improve, and we strive for this balance. The total sustainable financing portfolio of the group reached 25 billion in 2022. And this is on track to meet our target of 30 billion by 2025. Moving on to the next section. So this is just to highlight on our consistent track record of execution over the years. So here I'm showing you the loan base of UOB loan base has increased more than 10 times over the past 2 decades, as seen in the chart on the left. While on the right-hand side is a chart on asset quality. Our non-performing loans ratio have remained pretty much stable at least in the past decade. So we have never compromised on our asset quality while growing our loan book. If you look at the chart on the right-hand side, so NPL ratio was quite high after 98 Asian financial crisis. However, since then, we were able to clean up the book and adopt also more prudent underwriting practices. I think over the years, we have learned from our mistakes, and also this strengthened our credit policies. So as a result, you can see that our non-performing loan ratio has been maintained at a very low and stable level between 1% to 2% throughout various economic cycles since 2007 or 2008. So over the past more than 10 years. And next, in this slide, I'll just show you our loan book. So in terms of geography, half of our loans come from Singapore. The remainder is spread across Asia. Our key markets here are Malaysia, Thailand, Greater China, Indonesia. There's no particular concentration risk in any of the regional markets. And in terms of the sector, it's also quite diversified, as you can see there. And lastly, in terms of customer segments, we are serving individuals, retail customers. We are serving SME customers, as well as large corporates, which represents about half of the book. And next, on slide 18 here, is our deposits franchise. So at UOB, our business is mainly funded by customer deposits. We have done multi-year of effort and strategy to cultivate trust from our customers and build the strong deposit franchise. So we're pleased to say that our strategy has paid off. If you look at even during the height of the pandemic in 2020 and 2021, where we practically pay very low deposit rates. I mean, if you remember those days, we continue to see net inflow of deposits with any major outflows. And we believe this is also attributed to our strong AA range credit ratings that gives comfort to our depositors. And in terms of the deposit mix, fixed deposits have been increasing in proportion to total deposits as rates have risen, and we have started offering more attractive deposit rates to our customers. On slide 19 here, so basically from the loan that is steadily growing, backed by steady funding, what I want to show you is that it translates to resilient income and profits growth over the years. So even during economic periods like the 98 crisis, 2008 crisis, and the recent COVID pandemic, you can see that we continue to post positive profits. And sure, some of the years, the earnings may fluctuate, but I think even during crisis periods, we always weather through and emerge stronger. And then next slide is just to highlight on our dividends. So to reward our long-term shareholders like yourself, We currently have a policy of paying out 50% of reported profits as dividends. So in 2022, this has resulted in a total dividend per share of $1.35. So I think you can see over the years that these core dividends that we pay show steady growth year over year. The only dip was in 2020, which was during the great times of uncertainty in the beginning of the pandemic, because MAS, the central bank, wants us to restrict dividends. As at that time, they want us to be more cautious and would like the banks to conserve capital. As long as we maintain our growth trajectory, I think shareholders who stick with us, invest in us for the longer term, can continue to look forward to higher dividends over time. And then it brings us to my next slide, which is a summary of everything that I've presented. So why should you invest in UOB? Basically, we give you the upside of growth opportunities and rising affluence in the region, while we continue to apply Singapore's standard of corporate governance in doing business. And as an owner-operated bank, the interest of our management is aligned with the long-term shareholders. And secondly, you get a bank that has been consistently weathered through ups and downs of economic cycles over the past 90 years and has consistently delivered on growth, earnings, and dividends year after year. So I think in a nutshell, on one hand, you get the growth upside. At the same time, you also get stability in returns. So this all is achieved through our approach in balancing growth with stability. So that's probably the end of my presentation. I hope it gives you more comfort in investing in us. Thanks for listening. Back to you, Zach or Benjamin.
Thanks, Priscilla. Now we'll move on to the Q&A session. Benjamin, who is the Head of Research and Investor Education for SIAS, will moderate this Q&A session. Everyone, you may input your questions in the Zoom Q&A box below, and our Facebook audience, please click on the link in the description box to join us here at the webinar to post your questions. We'll try to answer as many questions as we can within the time limit. Over to you, Ben, to take over this. Thank you.
All right, thank you very much, Zach. Thank you very much for the very fine presentation, Priscilla. So very grateful that, we are always very grateful that UOB comes to talk about its earnings and its strategy. So we had your colleague, as I mentioned just now, previous time, that was also very helpful. So thank you for spending the evening with us. Now we do have a couple of pre-submitted questions. We're going to go through those first, and then after that, we'll get to the questions that have just been submitted in the Q&A function in Zoom. Okay, the first question we want to discuss is about the dividend policy. So as you mentioned, there is a very stable and consistent and well-articulated dividend policy in UOB. So the question here is, would you be able to elaborate on the dividend policy and to give some kind of indication as to what kind of dividend a shareholder might expect in August this year?
Okay, yes, as I highlight in that dividend slide, so our dividend payout policy is to pay 50% out of our net profit, reported net profit. So again, as we see outlooks are brighter for this year as well. I mean, we have seen margin expansion throughout last year that contributed to the increase in our earnings. I think this year we also should see more margins expansion with the rates in the US and also in Singapore still rising. So we see our profits again going to post positive growth this year. So our dividend should also further increase from 2022 position.
Okay, all right. The next question would be about exposure to the Chinese real estate sector. I guess this alludes to the inclusion of China Evergrande and so on and so forth. So what is UOB's total exposure to the Chinese real estate sector, specifically to which companies, and has there been any change since the last presentation?
Yeah, so our exposure to Chinese developers is small. I mean, in the overall scheme of things, right, compared to our loan book, it's just 1% of our group loans. And the amount, I think, more or less have been stable since the last presentation. The asset quality there is has been resilient in this portfolio. as all of our exposures are to strong players. So either they are state-backed or government-backed, or they are tier one names. So we don't bank with the tier two or tier three property developers in China. And our exposure to private developers in China also mostly have projects in outside of China, so maybe in Hong Kong, targeting these China mainland buyers. So with the China border reopening, I think now the mainland Chinese buyer can travel there to view the assets. I think this is positive for the businesses of these real estate developers. I mean, compared to previous years, where it was COVID and people cannot travel. So again, I mean, we have no exposure to the smaller players in the tier two, the tier three kind of developers, and we don't have any exposure to Evergrande or Country Garden and the likes.
Okay, that's very reassuring. Okay, let's move on to the questions that have been submitted in the Q&A function. Actually, 2 or 3 of them are quite similar. It's regarding the any kind of possible impact on UOB with regards to Silicon Valley Bank, and of course, the period before that was Silvergate Capital, so on and so forth. There seems to be a lot of media coverage, and obviously the regulators in the US have taken over the bank. So is this kind of like echoes of Lehman Brothers, or is this a nothing burger?
Okay, I mean, I just want to highlight that from UOB side, right? I mean, we don't have any direct exposure to Silicon Valley Bank or, you know, your Signature Bank, you know, these regional banks in the US. So that's one. As you know, that we are a DSIP bank in Singapore. So we are domestically systemic important bank with over 20% market share in loans and deposits, as I highlighted in my presentation. So we are tightly monitored by the regulator, by MAS, right? And we have a sizable and diversified deposit base, and our investments in the securities portfolio, they are highly liquid and typically short duration. So this results in a strong liquidity coverage and net stable funding ratio. So our liquidity metrics are comfortably above the minimum requirement. I think we are in different situation compared to these banks in the US. So, you know, these US banks that have failed, they've got a niche depositor base concentrating in some startups, where in UOB, our depositor base is stable, it's diversified. So it's nothing compared to the niche and narrow market that they address in the US, these banks that failed. And they also, in terms of the investment in securities, right? They invest in long-term securities, so the losses may be huge when interest rate turn in the direction. But here in UOB, we typically don't invest in those. We typically invest in shorter duration securities. So I think, yeah, quite a different dynamic, different situation that we face here. So can have some comfort that, you know, it's not going to be the same with the US banks in terms of the situation there.
Yeah, I think it's quite different. My impression is that SVP, most of the developers most of the depositors are basically multi-millionaire venture capitalists, people who drive around in a Ferrari. Well, your depositor base is basically people like me, salary
like me as well.
Yes. Okay. So jokes aside, there is a related question because UOB and Temasek co-owns an entity called Innovan Capital India, which was a rebranded as VB India Finance. So that was, I think, I guess based on the question, Temasek bought 100% stake and is now co-owned by Temasek and UOB. Now, obviously, it's a different animal since it was 100% bought by Temasek. But is there any kind of exposure with regards to that? And does Innovan Capital India have got the same risk factors as their previous parent, as VB USA?
Yes, I'm quite surprised to read this question because I thought that this is a difficult question, but I can answer. So yes, Temasek and UOB jointly acquired this Innovan with an equal share. So we both fully acquired from Silicon Valley Bank, but since then, absolute control of the management of this Innovan Capital have been with Temasek and UOB. So there's no involvement whatsoever, no link anymore towards Silicon Valley Bank. And we can say that this venture has been profitable since the acquisition in 2015. And gearing is very low, but business is definitely is doing good, and definitely there's no more link with regards to Silicon Valley Bank as of now, because we with Temasek and UOB are jointly having the full control.
Okay. Another question regarding the current meltdown in the US banking sector. So any potential second or third order impact from the bank runs in the US? I guess the the history here is obviously even Germany said that they had no exposure to Lehman, and then later on they said that they did simply because of all the counterparties and the derivative contracts, so on and so forth. So is there any kind of 5,000-mile link between SVB, the US banking sector, as well as UOB?
Yeah, I think to highlight here is that we also don't do business with the startups or the kind of clients that are customers of Silicon Valley Bank. So that's one. And I mean, with regards to broader market implications, it may be too early to tell. But then, if you look at how things have panned out, right? I mean, over the last 2-3 days, looks like the Fed in US is doing everything they can to maintain the confidence in the system. So they have been backing deposits of these banks that failed. So I think if you're talking about third or second order impact, right? I mean, if Fed is can succeed in containing this risk and restoring market confidence, I think we should not have contagion effect. So hopefully no second or third order impact from this, and hopefully this doesn't turn into what happened in 2008. We continue to see how things unfold, but that's the hope.
Okay. All right. So I guess in a nutshell, this is not the zombie apocalypse, not yet.
Yeah.
All right.
Hopefully.
Okay. Now, is there any or do you have any guidance on perhaps the potential earnings per share or dividend growth of UOB?
Okay. Yeah, so I think we guided a few things during our result briefing as well in 23rd of February. So I can walk through some of our earnings guidance. I mean, I wouldn't just quote one number like what is our earnings growth will be for this year, but I can guide a few things. So for the loan growth itself, we guide for mid-single digit for this year. So compared to last year, it was about 3%. We think that this should be higher in this year, especially in second half when we in ASEAN. I mean, us being an ASEAN-focused bank, also feeling the spillover impact positively from China reopening. And on the margin side, so if you look at last year, it actually expanded by 30 basis points. And at the end of last year for fourth quarter, the average was 2.22%. So I think for this year, margins can stay around the area of 2.2%. But again, this is also depending on how interest rates situation, I mean, with the Fed in the US panning out. Assuming there's no rate cut for this year, we can maintain around 2.2% of margins for this year. And then on the fee income side, I think we can continue to see growth. So from last year, it was actually quite soft. It declined year on year, but from the low base, we expect to see double-digit kind of growth. And on the cost side, we guide stable cost-to-income ratio and credit costs. So I mean, in a nutshell, to sum up, we see upward trends in earnings because of the higher income from loan growth, from margins expansion, while at the same time we maintain reasonable cost growth. So this should mean positive earnings growth, and we are confident that profits will improve again compared to last year.
Okay. Just to quote your colleague who presented last time, and of course not to put you on a spot, but I think he mentioned that for every 25 basis point increase in the Fed funds rate, the net interest income of UOB increases by 200 mil or something like that. I can't quite remember. Is that still the case?
Yeah, so I think that's our guidance, and it still remain about there. So about every 25 bips of Fed rate hike, we should see a 3 to 4 basis point uplift in our net interest margin about 150 or 300 net interest income higher per annum. So I think on the NIM side, right? I mean, as you know that last year we expanded 30 bips year on year. So if we can achieve this 2.22% average NIM for the full year, I think it's also about another 30 bips of margin expansion in 2022 and 2023. So I think just to give you an illustration of how margin expansion can benefit us, again, similar to last year.
Okay, good. All right. Moving on to a different question. What is the bank's portfolio of securities made up of? Are there any unrealized losses on bonds there on UOB's books?
Yeah. Okay. So securities portfolio, I mean, in a nutshell, it's 13% of our total assets. So it's not very big. And from this 13%, about half of it is parked in government securities, which are highly liquid, and the remaining 6% is actually parked in so like the 7% is from into government, and 6% in bank and corporate securities. But I think we can highlight that all of these securities are highly liquid kind of securities, and the average duration or the tenor of these securities is also low. I mean, about 3 years. And if you talk about our portfolio, right, mostly it's available for sale portfolio. And if there's any hold to maturity portfolio, so because investors, they tend to look at this hold to maturity portfolio, and they want to know how big it is, as in our unrealized losses will come from this portfolio, right? So I think we can say that this is fairly small. So compared to that 13%, so this is 4% of our total assets. So I think that's hope to give you some comfort on that we don't expect a huge unrealized losses or things like that. I think it's in terms of the mark-to-market loss, it should be fairly small compared to our capital base, and it's within our risk appetite.
Okay, all right, good. Next question is regarding UOB's strategy in expanding into Vietnam, Thailand. So these are naturally emerging markets, so low GDP density, lots of people spread out over a big country, rural areas, so on and so forth. So what is UOB's strategy to capture this potential retail revenue? Because obviously it's not like Singapore where you can walk into a shopping center and then there's a UOB, right? So these are few people, big country. How do you intend to acquire them as clients?
I think the strategy that we have in the regional markets compared to the Singapore market, which is our home market, and here we are very entrenched, right? We have high market share, where in these regional countries we typically don't have a big market share. So I think the market share that's the largest was only in Malaysia, where we have control of 5% market share. But in Indonesia and Vietnam, we are pretty small. And this is actually our strategy, that we don't want to bank with everyone there. So we purposely avoided, going big into the mass market, but we want to be selective. So typically in these markets, we want to target the upper mass affluent segments. So that means that, these people are usually in bigger cities. So we are not like gonna target all customers in Indonesia, up to the small rural areas. So I don't think it's our strategy. Because why we tend to be selective here? Because we want to contain also the asset quality risk. If we go to these markets, the emerging markets, yes, the growth potential is high. I mean, the returns can be quite high. Because of the low penetration, people there are not banked as much as in Singapore. However, we also understand that the risks are also high. So we rather want to balance this return against the risk. So again, with the regional markets, as I mentioned to you in the loan breakdown chart, the pie chart earlier, we have no major concentration risk in any of the market. I think Malaysia is our biggest at 10% of the loans. Thailand is 7%. Indonesia is about 3%, and Vietnam is small at maybe less than 1%. So I think that's our regional strategy in these key markets.
Okay. There is a question about whether or not UOB would be able to maintain its dividend as well as, I suppose, EPS guidance while averting a downgrade. I guess this is a credit downgrade by Fitch, which has a negative outlook on UOB.
Yeah.
So what's the strategy in order to manage that?
Okay, so yeah, we have to be balanced in terms of between our equity investors, like I think those who are tuning in tonight, as well as the fixed income investors, which are represented by the credit rating agencies, right? So Fitch's negative outlook, yes, it was due to our capital pressure from the acquisition. So earlier last year, when we announced we want to acquire CT, the 4 markets portfolio, we guided that there could be a 70 bips impact in terms of our capital ratios. So it can bring it down from that current level, the level of near to 12%. So I think it was 12.8% based on the pro forma calculation. And I think for Fitch, the threshold that they're looking at is around 14%. So when they see it's coming down towards 12%, they're not comfortable. So because they see that it's quite far from that threshold, that's why they put us on a negative outlook. However, I think with the development, I mean, throughout last quarter, we already consolidated Malaysia and Thailand in November. And this represents bulk of the CT acquisition. So those are the 2 largest markets. But our CET1 ratio has remained strong at 13%, 13.3%. So it didn't fall 70 basis points as what we originally guided and they originally estimated. So we are hopeful that the rating agency see this as a positive development, and will also take a second look, maybe during their upcoming review this year, whether they can resolve the outlook.
Okay, but this is only Fitch, right? So
yeah,
Standard & Poor's and Moody's.
No, they have us on stable. The ratings didn't change from last year.
Okay, so I guess you know who your friends are.
Yeah, I mean, this rating agency, they have different methodologies. That's why, I mean, they can come up with a slightly different outcome. Yeah.
Okay, fair enough. All right, there is a question here about UOB's long history of doing business, as well as a banking entity. Was there any kind of bank run? And really, I have no idea. Yeah, was there any kind of bank run that UOB ever experienced? If so, how did that happen, and how did UOB manage that situation?
I think as far as I remember, no. I mean, in Singapore, nothing like that happened. But I mean, 98, I mean, in some of the markets, right? We see Indonesia, maybe Thailand, but I don't think so in Singapore. And as compared to the 98 situation back then, I mean, our bank is much bigger now. We are more solid in terms of capital position, in terms of liquidity and all that other financial metrics. So I think, yeah, we shouldn't compare to the past anymore, since that we have grown so much from there.
Okay. All right, good. Another question about the corporate structure. So this one is about the share buyback policy. Is there any kind of specific price level that UOB will start initiating a share buyback?
I mean, there's no specific policy or like target in that area. So I think it's in terms of our capital, like I mentioned, I mean, just reiterating on a dividend payout policy is 50% payout. So in terms of getting the return of your investment, I think for retail investors, you can expect from there. I mean, that's our guidance, and that's what our target is for the dividend and for the return to shareholders.
Okay. All right, let me see. Okay, all right, back to the business strategy. How many ultra high net worth individuals are captured in the acquisition of CD Group? And was there a percentage of CD Group customers which decided not to continue banking with UOB?
Yeah, so maybe that actually there are two questions to that, right? So on the assets under management, so if you refer to the high net worth individual, so remember I highlighted our AUM position. It was 154 billion at the end of 2022. So actually 6 billion from that figure came additionally from Malaysia and Thailand portfolio that we acquired from Citi. So that's just to answer the question of the proportion. And the next part, what was the next part again, Benjamin? Can you remind me?
Yeah, so the next part is, and I'm trying to remember, the next part is about was there a percentage of CD clients that decided not to bank with UOB?
Okay. Yeah. So customer attrition, I think we guided for, I mean, when we did our due diligence, we expected around maybe 10% of attrition. But I think so far, the holders of UOB and Citi card in Malaysia and Thailand, I mean, they continue to hold those cards and they continue to spend. So in terms of the revenue attrition, we don't see any significant numbers, any significant amounts over there, because I think Citi and UOB, we offered a different value proposition to the customers, but when everything is merged into UOB, when customers surrender their Citi card and then get the UOB card, I think eventually they will still get all of the benefits. So because of the partnerships also that Citi have, we will also take over into UOB. So like the merchants and everything, customers shouldn't worry that they are missing, some of the value of using their card. So I think we want to make sure the transition is smooth on that front.
Okay. Okay, going back to a more technical question. So current accounts, right? So you've got current accounts make up about 30% of UOB's total deposits. With the outflow of deposits towards T-bills as well as fixed deposits, what could be the level of the current accounts at the end of this year?
Yeah, so I think from when it was COVID situation, right, pandemic, where it makes no difference for retail customers and the corporate customers when they deposit their money. It doesn't matter whether they put in CASA, current account, or in fixed deposit, because the rates really it's not materially different. But then since third quarter last year and the fourth quarter last year, I think rates have started to pick up, and that's why it's more attractive to invest in fixed deposits. And we were also competing with Singapore T-bill, Singapore saving bonds, also giving a high yield, right, about 4%. But I think in terms of the flow from CASA, from current accounts into fixed deposits, we see a slowdown already, especially if you look at the T-bills rates and saving bonds rate. It has gone down below 4%, right? So I think the competitiveness there has also been softer, and we can expect our CASA ratio to be more or less, hovering between 45 to 50%. I think that's probably achievable, given that we are not so aggressively campaigning on fixed deposits anymore. Things have looking stable. Competition with the T-bills or Singapore saving bonds has also slowed down. So that's what the expectation is.
Okay. Just now we had discussed the high net worth individuals. So now the question is about family offices in Singapore, across the region. Does that sector contribute, or how does that sector contribute to UOB's overall strategy as well as revenue?
Yep. So as I mentioned, the wealth management side, right? Overall fee income, it was quite soft last year, especially third quarter, fourth quarter. While the slowdown has declined, we also look at first quarter this year that the wealth management activities have picked up significantly. So things are looking brighter. And so from the low base last year, from the weaker performance, we should see a stronger performance this year in the wealth management side. So for just to give an illustration, we continue to deepen our engagement with our customers in the private wealth side. So during 2022, so throughout last year, we acquired, I think, 30 30 new family offices into our as a UOB customer. So I think we can continue to expect those kind of momentum to resume also for this upcoming 2023. So that's one of our key strategy in the retail business, actually, on to leveraging this wealth opportunities, capturing the rising wealth in the region.
Was one of the 30 accounts, did it belong to Jack Ma? Or maybe Mark
Sorry,
Zuckerberg?
cannot disclose.
Yeah, it's a trick
Customer confidentiality.
Yeah, bank secrecy act. All right. Moving on to something else. There is a not insignificant risk of a global recession. In the worst case scenario, would UOB be able to provide some color about its non-performing loans?
Yeah. Okay. If you talk about asset quality, right? I mean, yes, there could be a recession in the US or Europe or other parts of the world this year. But I think for Asia, generally our view that the economy activities here should remain holding up. Compared to some of the other parts of the world, and especially if the labor market unemployment is kept steady in the markets that we operate in, I think we should not expect to see systemic stress in asset quality as a result. So as of now, we don't see any signs of systemic stress, and even if there's any deterioration, I think we continue to do stress tests. I mean, closely monitored by the regulator as well in doing this stress test regularly on our portfolio. We think that the deterioration of the loan book should be manageable. So currently our non-performing loan ratio as of end of last year was 1.6%. We think that we can maintain it comfortably below 2%. And again, with China reopening, right, it will be another boost to for us in ASEAN, and I think this should come maybe more in second half of the year, and overall should support our asset quality as well.
Okay, and if I recall correctly, UOB is one of the local banks which are actually quite conservative in booking NPLs, right? As in, quite robust risk management, as well as quite conservative in accounting for non-performing loans. Yeah.
Yes, that's correct.
Yeah. So shouldn't be any surprises, I suppose. Because my deposits are with you, so. Okay, so
you can be rest assured. I mean, we have the AA range credit rating from the rating agencies, right?
Yeah. Okay.
So give you comfort there.
Okay. All right. So just now we were talking about the wealth management business. So how does UOB's wealth management business compare to DBS? Because obviously the most recent earnings from DBS was stellar. Interest, non-interest fee business were all firing on all cylinders, as well as OCBC that has got the BOS, Bank of Singapore. So what are the ambitions, the strategy? How do you intend to compete with the other two banks?
Yeah, I think, I mean, as a general trend, right, last year, when we if you look at the wealth management business, I think for the slowdown that we are seeing, the competitors are also seeing. So DBS and OCBC, I mean, in terms of wealth management growth year on year, I mean, they also saw a softer fee income coming from there. So I think as a whole, I mean, we want to maintain our market share. I mean, in terms of this business, and I mentioned to you that we have been engaging more deeper penetration of clients in the private wealth space, with my illustration, right, example of family offices. So I think things will be looking more robust, and I think more solid. We can compete more solidly with our competitors also in this business in 2023. So just hope that the market situation come down, especially in the US, and if people are starting to invest back into equity, into fixed income markets, we will also see growth in this space.
Okay. All right. There is a question which is more of a clarification. Did you mention that $154 billion was acquired from Citi in the four markets from Citi, and out of this 6 billion was from Malaysia and Thailand.
No. So 154 is the total of our existing base at the end of 2022, and that included the Malaysia and Thailand portfolio of 6 billion.
Okay, all right. Okay, good. So I think that's all the time that we have for. It's 8:10. Very grateful, Priscilla. It's been a joy talking to you.
Thank
really
you.
like your candor, right? Obviously, you don't have a script. And how do you remember all the statistics? 15%, 6%.
Because we talk to investors all day, and basically their questions are pretty much the same. So that's why.
Oh, right. Okay. We will try to come up with more creative questions for you the next time. But jokes aside, thank you very much. Very grateful always, because our clientele base are obviously not high net worth individuals or fund managers. Always very grateful if UOB comes to talk to us. Okay. Zach, so over to you.
Thank you, Ben. Thank you, Priscilla. I think we have a long list of questions tonight, and thank you, Priscilla, for going through every single one of them and giving us very thorough and elaborated answers. I'm sure if there are more questions from investors, you may reach out to UOB Group's investor relations page. I think there's contact details for you to reach out and ask more questions if you want to. But for now, we have come to the end of the session. Thank you, everyone, for joining us this evening. In case you missed any part of today's session, you can rewatch the webinar on SIAS YouTube channel. Now, Corporate Connect is a bi-monthly webinar, and do visit our SIAS website to get updates on our upcoming investor education programs and initiatives. The next Corporate Connect will be on the 21st of March, featuring Fraser's Logistics and Commercial Trust. Once again, thank you everyone for joining, and have a great evening. See you.
Thank you.